Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So one of the pretty common philosophies out there in the investment world is that more often than not, great companies turn out to be great investments. And I want to tackle that issue a little bit and try and put up an argument that great companies can be great investments, but not if you pay too much for those businesses. So there's a couple of examples of pretty big companies, very successful companies, where investors involved in those businesses actually haven't done that well over like a 10 or 20 year period, a pretty long period of time. So I want to dive into that. And then one of the other things that Charlie Munger always says is invert, always invert if you've got a problem. So if we flip that on its head, how can we identify companies that are going to be great investments regardless of the actual underlying quality of that company? How can we get into perhaps slightly poorer businesses or businesses that seem to be a little bit poorer on the surface, but can actually turn out to generate really high returns and be phenomenal investments for people that are involved in the stock market? So I hope you enjoy the video. As I say, if you do, hit like, hit subscribe, and love to hear your thoughts down below. So drop some comments down below. But for now, let's get into it. So the first company I want to talk about that has been a phenomenal company, but not the greatest investment over the last couple of decades, is CocaCola. So everyone knows CocaCola. They don't just own the Coca-Cola branded drinks. They own pretty much every drink under the sun at this point. They own a lot of beverages. If you don't know Coca-Cola, you've been living under the biggest rock in the world. So I won't explain what the company does too much. But they're probably one of the most successful brands of all time. And over the past 20 years, they have returned terrible investment results for investors. So if you look back from 2000 to today, the stock's up about 25%, which over a 20-year period is shocking. Obviously, you're getting paid sort of a 2 or 3% dividend each year with that investment as well. But in terms of capital appreciation, that investment has been a terrible one over the past 20 years. And it's interesting because it also happens to be one of the most famous investments of all time of Warren Buffett, who's probably the best investor of all time. So Warren Buffett bought about $1 billion worth of Coca-Cola shares in Coca-Cola in 1988 through his holding company Berkshire Hathaway, and between 1988 and 2000 that investment gave Warren Buffett about a 12x. So it turned from about $1 billion investment to about a $12 billion investment. Phenomenal returns over that sort of 10 or 12 year period. But since then, it's been a shocking investment. And I want to run you through some of the basic reasons why. So although Coca-Cola is a phenomenal business and the business has actually continued to perform quite well over the last 20 years, as I said earlier, if you pay too much for that business, your returns are not going to be great. So to walk you through some of the basic numbers for Coke, if we roll the clock back to the year 2000, Coca-Cola was earning about 88 cents per share. The shares were trading in the mid sort of $40 range, and that put the PE ratio, so basic sort of valuation metric for Coca-Cola, right around a PE of 50 or just below 50. So they were trading at 50 times earnings, which is a substantial multiple even for a really good company. So this was right in the midst of the tech boom, and through all these big, technology IPOs that were attracting huge amounts of money, we had a lot of blue chip companies like Coca-Cola start to get into really kind of expensive territory as well. So Coca-Cola was trading at 50 times earnings, and regardless of how good a company Coca-Cola is, it's going to have to grow at a ridiculous rate to give you good results. So to run you through some of the basic maths of that, and we'll get into the numbers specific to Coca-Cola in a sec. If you buy something at 50 times earnings and that multiple eventually comes back down to earth to say 15, 20, 25 times earnings, somewhere in that range, let's take 25 just to make the math simple. If the PE ratio is going from 50 to 25, then for the value of each individual share to be the same, then the earnings per share are going to have to double. And that's basically roughly what's happened with Coca-Cola. So they're now earning about $1.60 odd per share in 2019. The company has basically doubled since the year 2000, but that multiple has also come way down. So they're now trading at a 20 odd PE. or maybe even at a 30 PE at this point. They are still at a reasonably high multiple. And investors have basically made no return. They've made 25% over a 20-year period, which is shockingly low. And they've, collected some dividends in the meantime, but it's been quite a poor investment. And the thing I really want to stress is that Coca-Cola, the company, has done well. The company's become from, the giant they were already in 2000. They're now twice as big in 2019. They've doubled the company, yet investors have basically nothing to show for it. So what I really want to stress is that regardless of how good a company you're investing in, you do have to pay an appropriate price. So that's example number one. I also want to dive into another company, which is Microsoft. So let me just grab some of the numbers for Microsoft, and then we'll get into that. So Microsoft, I'm sure you all know the company there as well. Huge technology brand, provides software to a hell of a lot of PCs in the world, and I'm sure you use their software probably most days if you have some Microsoft software. So the maths is actually pretty similar with Microsoft. So if we right back to the year 2000 again, Microsoft were obviously one of these big names that were caught up in the technology bubble that was going on in the early 2000s. And again, the actual underlying company has done very well since then, but investors haven't done that great over a 20-year period. So I'm actually going to take a snapshot from the year 2000 to the year 2016, a 16-year period, and I'm choosing that because it actually took from 2000 to 2016 before investors were in the green, before they actually started making money on that investment. So Microsoft stock went down a heap after the year 2000. It did a whole lot of not much for a long period of time, and then eventually started to climb back up to the point where in 2016 they were trading at about the same level they were at in 2000. So like I said, the maths is pretty similar. At earnings per share of a little over $1.40 in the year 2000, and they were trading at a PE of about 50. So a big multiple, especially for a company that has obviously had a lot of growth, but that growth is probably starting to slow by that point. And if we fast forward to 2016, the company was about 80% bigger in terms of their earning power. So they were earning about $2.50 or so in the year 2016, but their stock price was exactly the same. So that multiple had come back down to earth. And again, it's another example of a company that's done phenomenally well. Great company, earns heaps of cash, grows over time, all that kind of stuff. But if you pay too much upfront for the business, you're just not going to get great returns for that company. And interestingly enough, Bill Gates, obviously the founder of Microsoft, he actually sold a hell of a lot of shares in Microsoft in and around the sort of turn of the century. And if you look at his portfolio now, he's much more diversified into other businesses. About 50% of his portfolio is actually in Berkshire Hathaway, Warren Buffett's company. So he wasn't quite as caught up in this sort of big tech boom and bust as he might have initially thought. So that's an interesting side note. So those are a couple of examples of companies, really good companies, that just haven't provided great returns over the last decade or 20 years. So I'm going to flip that on its head. Like I said earlier, Charlie Munger says to invert the problem, always invert. So I'm going to show you an example of a pretty crappy company in a crappy industry, but one that has provided phenomenal returns for an investor by the name of Mohnish Pabrai, who, if you've watched some of my videos before, you are probably already familiar with, but we'll dive into that anyway. So stick around. So the investment we're going to talk about from Mohnish Pabrai is in the company Fiat Chrysler, and that name is incredibly boring. When you say Fiat, you think of those little hatchback-looking things that look horrendous. Fiat Chrysler actually, at the time, back in 2012, when Mohnish first made this investment, did actually own several other brands, and they still do own most of these, but they own, as it stands today, they own Jeep, they own Ram trucks, they own Ferrari, or they did at the time. They own Maserati, Alfa Romeo, all these phenomenal brands. They owned Magneti Marelli, which is like an auto parts manufacturer. So they were quite a diversified business, and the name Fiat Chrysler probably isn't all that representative of the actual company overall. But regardless of that, Mohnish identified this company that was trading at a very, very cheap valuation. So the company had come out with this business plan where they planned by 2018, 2019 kind of time to be earning about $4.50 per share. And if you go back to 2012, the company was trading at about $4.50 a share. They were trading at a PE of 1 based on 2018, 2019, 2020 kind of time earnings. So if they could execute on that business plan, it looked very cheap. And although Fiat Chrysler owned all these great brands, it's not something you'd really put in the sort of great business category for a few different reasons. So first off, they're in the automotive business. It's an extremely competitive business. There's so much competition, and competition can only really do one thing for your margins in a lot of ways. So it squeezes your margins. It forces you to try and compete on price when you've got various other car companies making their own vehicles. It's a company, it's a business where there's a lot of sort of creative destruction. So every year you have to invest back into the business to retool your factories and do all these things to bring out new models of cars. And you've also got at kind of the other end of the business with your workforce, you're in a business that is quite heavily unionized. So you can often have increases in labor costs that are quite dramatic because you've got unions pushing for higher wages across all these different car companies, and all these companies have sort of the same pressures. So there's a lot of things that fundamentally make the car business a tough one compared to technology businesses where you're not as capital intensive and you don't have unionized workforces and those sorts of things. But when we look at the actual returns that were potentially possible with this Fiat Chrysler investment, it's almost the opposite of the CocaCola and Microsoft situation. So that situation was great business, poor investment. Fiat Chrysler was sort of poor to average company, but phenomenal investment. So Mohnish bought into that stock when it was trading at about $4.50. Fiat Chrysler, as of today, is trading for about $13. They've also spun off Ferrari, so as well as, about a triple on your initial investment with just your Fiat Chrysler stock. They've also spun off Ferrari, so if you were an initial owner in Fiat Chrysler when they own Ferrari, you also now have Ferrari stock, and that in and of itself I think accounts for about another $5 a share, so that's another multiple of your money again. And they've also paid out things like special dividends when they sold off the Magneti Marelli investment, and they've still got business plans to go and continue to grow the business, and they're still only trading at like a PE of 4. So don't take that as a stock recommendation or anything, but it's a very interesting business because relative to the cash they produce and relative to the plans they've got to grow the business into the future, they are trading at a very, very cheap valuation. So that's basically all I've got for today. I hope you enjoyed the video and comparing great companies versus great investments. Obviously, as stock market investors, great investments is what we're after. The great companies, although they often do continue to grow and the underlying businesses do very well, you've got to pay an appropriate price. Often these really great, well-known businesses are very easily understandable. A lot of people know about them, and they're often hard to pick up at those really cheap kind of discount to intrinsic value type prices. So you've got to dig through the weeds a little bit, find something that's a little bit hairy and maybe got a couple of characteristics that aren't all that great about the underlying business, but we can produce really phenomenal investment returns if we're willing to look in that space. So hope you enjoyed the video. If you did, hit like, hit subscribe, and have a great day. Cheers.